Hi guys, welcome to the podcast. I'm Dragan, and of course we have our co-host Amanda here. Today we'll be discussing serviceability versus purchase price. And who best to discuss that is Anthony from Mortgage Works. Anthony, welcome.
Thank you for having me.
Thank you for coming on.
Here.
Welcome to the Passive with Property podcast, hosted by Dragan and co-host Amanda Calabria. With over 2 decades of property investing, Dragan is a qualified property investment advisor and buyer's agent. We're committed to the education of both first-time and seasoned investors in property investment and wealth creation. The Passive with Property podcast is brought to you by the Buyers Agency Australia.
You want to hit the road running here?
Definitely.
All right, let's do it.
Obviously, serviceability is just a part of a pretty simple equation. So obviously, once you figure out the loan amount that a client can borrow, and they've got a cash deposit to put on top of that, then you can pretty quickly arrive at the total funds they have available to make a purchase, and including state and territory fees, whether it be stamp duty, legal fees, and all those sorts of incidental costs.
Sure.
So serviceability is a big part of the equation. Quite often we find, interestingly, we actually ask our clients at the start of the process to tell us what their desired purchase price actually is, not just the loan amount. We don't just zero in on the loan amount. We actually look at the purchase price and we ask the client to give us their vision, so to speak.
Sure.
And it may well be that they can't get to that purchase price level that they desire right at this point in time, based on their borrowing capacity, obviously the serviceability piece, and or their cash deposit or equity from other investments or security guarantors and that sort of thing. But we work with them throughout the journey to get them to that vision, or the vision changes invariably over time.
What I find interesting, a lot of our clients will see their broker before they come to see us as buyer's agents. So they'll come to you guys and, as you said, you'll run an assessment, you look at their deposit, their desired purchase price and their serviceability. And then they'll waddle over to us with that information and whatever modification has gone on inside their own mind of that information. So when they come to us, they've obviously run their numbers, right? This is what I can service. This is the sort of purchase price or cash flow that I need in terms of rental yield. This is, the amount that I need the property to produce on an income level to supplement what I'm willing to put into it as well. Whatever numbers they've run in their mind, they then come to us, and purchase price becomes the biggest figure that they want to focus on, because overpaying obviously is a fear when you're coming to a buyer's agent and you're, I suppose, at their mercy when it comes to negotiating, because the buyer's agent is negotiating for the client. So purchase price becomes a really big talking point, because they don't want to overpay. They don't want something that they can't service because the cash flow or the rental yield might not be there if they're purchasing something under somebody else's guidance. So we find that when clients come to us, obviously after seeing a broker, the serviceability conversation kind of flies out the window a little bit because they get bogged down in all of the other numbers. So I suppose my question is, how do we help clients understand that once that purchase has been made, the purchase price is, it's a number that matters, but the part that stays with the client is that loan and that ongoing repayment that has to be made, whether it's from their pocket, whether it's covered by the rent, whether it's a portion of both or a combination of both.
Yeah, and from our perspective, in a real live scenario, purchase price is effectively irrelevant for an investor, particularly for a client who's looking to buy multiple investments. Purchase price is part of the equation. You'll help them through that in terms of value, but it's largely irrelevant. The biggest thing is serviceability, and that's the discussion we have with a client. And when I say serviceability, not the bank's serviceability necessarily, but cash flow, right? The client's got to get really, really comfortable in early on in the process what they can actually afford from a cash flow perspective, because the worst scenario that we would see is a client, unfortunately we very, very rarely see it, if ever, but a client goes into a situation where they overextend themselves from a cash flow perspective, they get a few surprises, and all of a sudden they're a forced seller in a market which may be unattractive in terms of timing. So the biggest piece that as an investor myself, or as helping a client build an investment portfolio, the most important thing that I've got to get comfort around is cash flow, right? So what is the likely rental yield what's the discount, what the net rent is, what does it look like if I'm without a tenant for a couple of months, what happens if I get some surprise, the house needs refooting, whatever the scenario, the worst case scenario, or if, one of our incomes drops, household income drops, what's on the horizon in terms of starting a family, all those sorts of questions which might come up over a 30-year loan term. You've got to get really comfortable around that, how you're going to cover that. And usually it's some sort of a cash flow buffer that we would consider for those clients, whether it's sitting in an offset account that they don't have to touch or even consider until the worst case scenario comes about. Hopefully it doesn't, but the reality is that it could. And so the biggest question for us is that cash flow rather than purchase price. That's fairly incidental for us.
Yeah. And for us, the focus is often on cash flow and rental yield as well. And it's far more important to go for that yield than to, get a 50K discount over a 30K discount on the valuation. And that brings us to valuations as well, because this is where a lot of our clients get tangled up. The purchase price is not the same as the bank val, is not the same as the real estate agent's appraisal. And a lot of people can often conflate the two, particularly the real estate agent's appraisal and the bank val. So can you walk us through what each of those are and how they function differently?
It would be one of the most common discussions I have with clients on probably a weekly or bi-weekly basis, I'd say, is the valuation process. There's so many myths and bits of misinformation out there around valuations, and people get spooked around property valuations. I would start off by saying that obviously there are broadly two types of valuations that a valuer is doing. Well, there's more than two, but if you take into account construction and whatnot, but by and large, there's a purchase sale valuation where you've actually purchased a property, you've got a signed contract of sale, you're handing that, you're uploading that in the bank's portal or the valuation portal. It's going direct to the valuer who's doing the assessment. And then there's a refinance valuation. So when you're moving from one bank to another, or you're going back to your bank and you're asking for equity out, that's a completely different type of valuation. So to touch on the purchase valuation first, this is the one where I'm most often trying to calm people down, because the stakes are high at that point. You've got a 10% deposit on the line in a lot of cases. It's non-refundable. All of a sudden their conveyancer or solicitors had a word to them and said, are you unconditionally approved? Which you can't be before you sign a contract, because the valuer requires the contract of sale and the bank requires a valuation before they'll sign off on a loan. So that's a really common discussion we have to have. But once you've got that contract of sale signed, we upload it through the valuation system. It goes direct to the valuer. The valuer looks at it and they can see there's a willing buyer, obviously, in the transaction. There's a willing seller in the vendor, and there's a real estate agent's details on the valuation as well. So a third party negotiating the purchase, and maybe even someone assisting them in if you're involved, which is very helpful. The valuer knows at that point that it's effectively the true market value of the property. A negotiation has gone on in a free market between willing participants, and they've arrived at a price that they're both happy with. Now, a valuer has to find effectively overwhelming evidence to suggest that the client's overpaid, and it's extremely rare to see that happen. And I think, I was mentioning this earlier on to a colleague, that I've probably seen, in over 1,000 purchase transactions in my career, I've probably seen 2 valuations on a purchase come in short, and it was actually the same valuer in the same location. I don't know whether
You're going to name and shame?
No, I don't want to get any more short valuations for my clients, but I don't know whether I offended their kids or something or what happened, but these 2 valuations have come in short on my properties. Now, in both instances, it was grossly incorrect where they'd come in shorter than the contract price. So we reached out to our real estate contacts and we got overwhelming evidence to suggest the valuer was wrong. We actually put that to the lender for the client, and the lender was actually so sort of on side with us that they actually agreed at their own cost to order a secondary valuation, like a check valuation, through another independent party, and that valuation came back at the contract to sale price, and then they agreed to lend to the client. So it was unsuccessful. If the valuer was trying to slight us or whatever it may have been, it was unsuccessful because the banks end up taking on the security at the contract price. And a lot of the time I'm explaining the methodology the valuers are using there, and what they're looking at is settled transactions. So sometimes people say, there was a property next door that sold, 2 weeks ago for X amount, right? It's not a settled transaction. So the valuer can just cross that one out when they're doing the valuation. They're looking for settled transactions. So typically between 3 and 12 months historically before you've bought the property. So interestingly, when people tend to be most nervous about short valuations, is actually when market conditions are bad, when values are going down. That's actually the least risky time to get a short valuation, because the valuers are looking back in time to see and they're seeing a property that you might be buying for $1 million. A very similar property sold in the suburb 6 months ago for 1.1 million. You're buying for $1 million. The valuer can easily sign off on that valuation, that contract to sale, because you've paid less than the person paid 6 months ago. Yeah. They're not doing a predictive val, estimating what it might be worth in 6 months' time if market conditions are cooling. They're actually looking at historical sales. So when I get nervous around valuations, and a couple of times I have sort of submitted a valuation request and gone like this, is when the market is rising very quickly. Yeah. So I've seen situations, particularly nervous situations where a client might have paid $400,000 more than the adjoining semi 6 months after that semi was sold and it was renovated, and my client's paid $400,000 more. But even in that situation, the value has gone straight in and signed off on it because they can see what's happening in the market. It's rising quickly. So the chances of a short valuation on a purchase sale transaction is effectively nil in my experience.
Can I ask about another type of scenario? Yep. Since you mentioned a rising market, I want to talk about people that they go for their pre-approval, which is not an unconditional approval, which you've mentioned. So for people that are buying off the plan and they've got their pre-approval and they think that they've purchased something that they can service, we talk about serviceability over purchase price, and say they're looking at something that's not due for completion for another 12, 18, 24 months, and the market does go up. Typically when the market goes up, we see interest rates follow, which can then impact their borrowing capacity, their serviceability. So in those instances, have you seen maybe finance fall over, not due to the bank vow, but due to the serviceability?
Really important point. Not necessarily the serviceability, although often when you're buying off the plan, anytime you sign a contract for a purchase and there is a greater than 6 month period of time until you actually get the keys, the inherent risk associated of something going wrong is elevated. And the longer the period of time, the more elevated the risk. So I've seen situations where people have bought a property, signed a contract to sell 4 years before completion. Wow. So there wasn't even a hole in the ground, all right? And in that 4-year window, the amount of external headwinds that hit the market were extraordinary. APRA tightened on living expenses, APRA tightened on interest-only lending, so rates went through the roof. Labor took property taxes to an election. All of these factors combined for a person who bought a property off the plan in 2016, it's completing in mid-2019, and not only was, if they were going interest only, which this one stands out, they weren't going interest only, but their serviceability would have been an issue because the interest only rates had gone up by over 1%, right, during that window of time. But the valuation was the biggest issue. So when you're buying a property and there's a very extended settlement time frame, like an off the plan, the risk of a short valuation can be very significant due to forces that are completely outside of your control. Like you mentioned, quite often people win on that transaction as well, which is a really exciting time. If you bought off the plan and you buy for $1 million and it comes to completion, you get a bank valuation at 1.4, that's fantastic. And quite often there are banks that will actually lend you 80% on the current market value rather than the price you paid. So that can be a big win for the customer in terms of duplicating and whatnot, but the risk is elevated the longer the settlement time frame.
The window I want to look at, where you mentioned, $1 million to 1.4 val, is if, let's just say, somebody looked at something off the plan in 2020, just before COVID came and gave us that black swan event. So say we've purchased something off the plan in 2020, markets have boomed, we're now at 2025, 5 years later, interest rates are significantly higher than they were, access to money isn't quite what it was. If someone signs something in 2020, they're looking to settle now. What does that look like? I mean, as a buyer's agent, Dragan cautions away from off the plan for these exact scenarios.
Definitely.
So what sort of boat would these sorts of people be sitting in on that timeline?
It's interesting. The scenario you've given is really very realistic, and I'd be expecting more calls. And there's been times in my career where I've been thrown those sort of hot potatoes, if you like, where clients in a really tricky situation because they've got completion and they need to know basically ASAP if they need to sell it, get on the market as soon as possible, and try and on-sell it so they don't lose their deposit, or whether or not there's any hope of them completing. And I haven't been getting those calls lately, and it's, from any of my networks. So I don't know how many issues, but theoretically speaking, if you look at what rates were in 2020 and where rates are now, obviously incomes have risen over that period of time, but you'd have to say, theoretically speaking, it would be a hell of a lot more difficult to service the same debt that you might have looked at 5 years ago.
We've thought about the same thing, and the best theory that we can come up is that new Supreme Court mutual rescission law. If build costs went up and the margin's not there for the builder, but the property's worth more, and then the buyer can't settle, there's a mutual interest there to rescind that contract.
Yeah.
So that's the best theory that I've come up with.
And you hope that that's what's going on.
And they're both saving each other.
Yeah, that's right.
Yeah.
And whether or not, I've had a couple of clients in the last 24 months, a couple that jump out at me, where the large developers were selling very close to completion. So whether that was a situation where they were struggling to move them early on or they didn't need to, potentially, struggling to move them early on in the build, and so they've held them till completion. And so then you're transacting in a far more certain environment for the buyer, because they knew not much was going to change in the next 9 to 12 months in my situation. So I can buy with a lot more confidence in that scenario.
Yeah. How many scenarios would you get? And I'm sort of asking this from a personal perspective, because I've personally been bitten by this, where a client will come to you and say, look, this is my intent. This is the purchase I intend. I've seen a buyer's agent. My buyer's agent has recommended something in this price range with this likely rental yield, this likely cash flow. This is my situation. You've run an assessment. You've given the green light and said, yep, I'm comfortable with that. They've gone and made the purchase. And then there's something that's been overlooked or miscommunicated, either by the client or by somebody else, where the deal might be at risk of falling over. And the reason I ask that is because I got caught up in a situation where we were looking at a block of land.
Okay.
And it was a block of land in an established suburb, but there was this one bloke that hung on to his acreage and just subdivided it 40 years after everybody else. So, we were given the green light, 80% LVR, we got the deposit, this is the purchase price, green light from the broker, go for gold. We signed with a 66W, so we forfeited our cooling off period. We were locked in. And then the lender, I think it was, came back saying, that's a suburb where blocks of land are considered anomalous, stock for that area. We're only going to lend you 70%. So we had to come up with a shortfall in cash, which we were able to do, but many clients that we work with might not have that. So in that instance, as a broker, I suppose, how much information, how forthcoming do people need to be before they sign a contract, or should they be coming to you once, what happens here?
Well, we always like to get a pre-approval, a conditionally approved loan in place, which gives you some comfort. It doesn't give you any comfort over the security. So when we send you our conditional approval advice, there is a section in bold which says, please check with your broker around things like high tension power lines, property size, sub 40 square metres or larger blocks, postcode restrictions, or specific building restrictions, which Westpac and St George, the Westpac group, is an outlier in that sense, that they look at each apartment complex in isolation rather than postcode restrictions. But most lenders go off postcode restrictions, and we hope, and we've never seen a lost deposit, of course, touch wood, but we've never seen a lost deposit. But we hope that our clients will come back to us and say, hey, you put this in bold and right, we just want to run this security past you. Most of our clients do run the security past us, and we'll quickly check things like postcode, any LVR restrictions, check the security development register at Westpac Group if it's a Westpac scenario, or St George more commonly. So we have those checks and balances in place to make sure before you sign that, we've actually ticked it off with the lender, so you shouldn't have any security issues. It's not foolproof. Sometimes things change overnight.
So do you tend to discourage 66Ws? Do you like cooling off periods for this reason?
No, I'm quite the opposite. We see that our clients quite often can benefit in negotiations from a Section 66W.
Yeah, this is why I got into trouble.
That's right. So we like to, as long as we've absolutely checked everything, we've got mitigants in place, we're comfortable with the scenario. I would hate to be discouraging my client from getting a competitive advantage in negotiations because I'm too scared to let them sign a Section 66W. We just like to mitigate all the risk before they do it. Yeah. It's so common in the New South Wales market, right? Yes. And that's often a discussion I'm having with clients, is that, even if they're buying a property that's not going to auction, but obviously if they're buying a property that is going to auction prior to auction, it has to be a Section 66W. But if it's a property which is maybe for sale for private treaty, and maybe the vendor's been given the runaround by a couple of buyers who have bought and then pulled out.
Yeah.
So they instruct their agent, we're only accepting Section 66W, an offer with a Section 66W.
Anthony, before we go any further, there's first-time investors out there that are asking the question, what's a Section 66W? Can you...
Yeah, so it's a document which you have your solicitor prepare, and this is where we often have to, there's a bit of back and forth in communications between us and the solicitor and the client. It's a document which waives your right to a cooling off period.
Yep.
So if you find out that there's any issue with either the property itself for the bank, for example, or if you haven't done a building and pest report, if it's an apartment, if you haven't done your strata report and found out if there's any hairs on the property, if there's any reason why your finance might be declined, you might get cold feet, buyer's remorse, all that has to be ticked off before you go with your Section 66W.
Sure.
Because you're on the hook for the 10% at that point in time, so you can't pull out.
And you usually see these in auctions, right?
Yeah, so if you're buying prior to auction, no real estate agent worth their salt will effectively sell a property prior to auction without receiving a Section 66W, which is exactly the same as buying at auction. You're just buying under auction conditions, waiving your right to a cooling off. And that's because the agent, once they've sold the property, if they give you a cooling off period prior to an auction, the first thing they have to do is call around all the other buyers that were interested and say, hey, property's gone, very sorry, you've missed out. And then if you pull out, they've got to call everyone again and say, hey, property's back on, and what does everyone think? There's something wrong with the property. That's why you pulled out, right? So no agent will allow that. And that's why, but it's the private treaty ones where we have the most issues. Most solicitors and conveyancers understand that if you're buying pre-auction, you have to sign a Section 66W because you're just buying under the same conditions. But it's when a private treaty transaction comes along, the solicitors really put their foot down and say, no, you should be getting a cooling off because it's a private treaty, but it's not always the case. So we just make sure that you've done all those tick off items that you should do before going to auction, and then you can sign under exactly the same conditions as auction, particularly if you get your competitive advantage.
You mentioned earlier that it can be a good bargaining chip, particularly if the vendor has had a few buyers previously drop out. So in the event that somebody does purchase and they do forfeit their, in other states it might not be called a 66W, it might be something else, but say wherever they purchase, they do forfeit their cooling off period. And then, for whatever reason, they can't get their finance from their preferred lender. As a broker, do you then start looking at second and third tier lenders, or do you go, sorry, mate, you've got to find the cash? Like, what happens in the event that they get caught out?
No, we turn over every stone. So and quite often it is, and we get referred these clients, right? Or people, that might be dealing directly with the bank, and then they don't realise that their bank is Westpac, and that Westpac have specific apartment complexes that they limit their exposure in. So they've gone and got their pre-approval, they've gone and bought at auction, they've done absolutely everything right, and then they walk back into Westpac on Monday morning, or St George, sorry to pick on these two lenders, but they walk in and Westpac and St George say, oh, no, we don't actually lend on that building. We've got no further exposure. We've got a heap of loans in that building, and so we're overexposed, and so we're not lending. And so they come to us and say, in panic mode, and we know that we could probably have that loan approved in 24 hours at any of the other major banks, stack of second tier banks, as long as there's no other hairs on the application. But quite often there is a policy hair. So, a client might, going back to your question, a client might buy a property in good faith and then for whatever reason get knocked back by their lender of choice. And again, it could be something due on their credit report, for example, which wasn't picked up on the initial screening. Quite often applications are conditionally approved by a lender, but then once you've actually purchased, it has to go to a senior credit assessor for sign-off for one particular item, and senior credit doesn't like a particular item. And again, if you come to us in that scenario, because we're seeing these all the time, with the banks in our office telling us what they can do and can't do all the time. We're getting daily updates from lenders. We more or less know exactly where we narrow it down to the lenders that will approve the application, dealing with that anomaly, the hair effectively on the application. And then obviously we present those options to the client, and we talk about the other factors.
Now, as buyers agents, we work exclusively with investors. So people with more than one loan, more than one property, more than one income stream as well. They're not just, living off their salary. They've got rental incomes and so on. what we find is that a lot of investors, they like their big four banks, they like their known lenders because they trust them. There's a trust factor there. We start talking second and third tier lenders, they freak out a little bit thinking, oh, that's an online bank. I don't want to borrow from an online bank.
Yep.
So as a broker, is there a disadvantage to borrowing from a lesser known lender, or is there an advantage?
Look, definitely not. I would say definitely not. And I have come up again, far less so, I must say, than when I first started it, 10 or 11 years ago. There was a bit of I used to get the question a lot, is there any concerns around going with, an ING or a Bankwest or a particular whatever it might have been, a lender that didn't have a very big presence in the New South Wales market or even on the Eastern Seaboard. And we could debunk those myths straight away, right? But I would say, to your point, that quite often the largest lenders quite often have the largest risk appetites because they're the biggest books. They can spread the risk across their book. So what we find is that they might be shading rental income to 90%, whereas a second-tier lender might have the sharpest rates, but they're accepting a lower return, so they're only willing to take on less risk. So they might shade rental income to 70%. So all of a sudden you've got a borrowing capacity advantage by going with a lender that is more aggressive on rental income shading. So you can get more borrowing capacity. The other lesser known way, and we didn't touch on this earlier when I was talking about the valuations, but with refinance applications, what a lot of people, obviously people think that the banks compete on interest rate, right? That's one factor. They also compete on policies. So whether it be 1 year self-employed, rental income shading, they'll take a higher percentage of rental income. And one lesser known factor is they'll compete on valuations as well. So we know some lenders at any given time, and we're running valuations for refinances, cash outs, investment purchases all the time. And we'll know when a lender has turned up their valuation tool to effectively inflate the price or it's hard to say inflate, I wouldn't say that, but they quite often will take a more commercial approach, probably take closer to the market value of the property on their desktop valuation system. So all of a sudden, that lender might be giving you, on a $1.5 million property, for example, you might be able to borrow an extra couple $100,000 in equity from just going with that lender. Plus you're getting 90% rental income shading, so you can borrow an extra couple of $100,000 more. All of a sudden, an extra 15 points on the interest rate becomes pretty relevant. So that might be why investors are sort of gearing towards certain lenders over others. Quite often, it's a policy and a valuation methodology decision rather than an interest rate decision.
Yeah. Can we go a little bit more into refinancing? Because what Dragan does when he looks for deals is he tries to, purchase properties at a discount, and he does that by accessing them off-market or pre-market before they are subject to market competition.
Yep.
So by doing that, just say somebody purchases a property that is, if it were sold in the open market, say worth $700,000, he might manage to pick it up for $650. Bank Val comes back at purchase price, which is what we expect at $650, because it'd be quite rare, I would imagine, for Bank Val to come in above purchase price. Yeah. So say $650, but then in 6 months' time, that person might want to refinance. It might be worth $700, $720. They want to, pull a bit of money out to put towards another deposit. How long should clients be waiting between purchase and refinance to be doing that?
Look, I'd say it's pretty much don't even bother in the first 3 months and probably the first 6 months, because the banks now, obviously to save money on sending a valuer out to physically inspect the property, they're relying much more on automated valuations, so their internal systems. And if they can see, and obviously all the data's fed in through RP data, core logic and whatnot, so if they can see a property's transacted for $650, it's registered on publicly registered sale price 5 months ago, it's incredibly unlikely the bank will value it higher, even on an automated valuation system that is aggressive. It's incredibly unlikely they'll value it higher within that first 6 months. If there's been a big market shift, let's say we see the hypothetical scenario this year, if we see another 3 or 4 rate cuts, which has been discussed, and the market starts to run a little bit, and particularly more in other areas, all of a sudden there might be an argument to say between 6 and 12 months, you might get a fortunate outcome. It can change pretty quickly. And sometimes the banks we notice their automated systems turn up when there's an expectation of market growth as well. So it's always worth running it to see what you can get. But in the first 6 months, it's highly unusual to see an increased val. Yeah.
And then, sorry, go on.
No, go ahead.
I was just going to say, to come back to a point you made earlier, some lenders might inflate, quotation marks, inflate their vows. It might save, the borrower LMI, for example.
Yeah.
So I want to talk about LMI for a minute. First, we'll get you to explain what it is, but then the LMI question comes up quite often for us as well, purchasing below value, but then purchase price being what goes towards that valuation, and then saving LMI versus paying LMI, buy now, buy later.
Yeah.
The whole LMI conversation. What's your view on that?
Look, it's horses for courses. Like my view on everything, there's no right or wrong answer when it comes to LMI. Lender's mortgage insurance, of course, it's a insurance which the bank takes out on the borrower's behalf, and it's a cost. It's when you borrow more than 80% of the value of the property. In some specific property types, it can be more than 70%, depending on the lender. But also there's some concessions for certain profession types, whether it be medical professionals, accountants, and financial planners, solicitors, and whatnot, where they'll actually lend you up to 90% of the value of a property, or even 95% in some cases, with no lender's mortgage insurance. But it's an insurance premium for the majority of borrowers, which is taken out by the bank on your behalf when you borrow more than 80% of the value of the property. Now, the way I've always looked at LMI is that it's effectively a cost of doing business. And if it's, a $10,000 insurance premium or a $15,000 insurance premium, as soon as the property's gone up $10,000 or $15,000 in value, the premium is paid off, right?
But you're in the market.
And if you look at the servicing cost, the actual interest cost on $10,000 or $15,000 at 6% interest rates or 4% interest rates, whatever wherever they're sitting at that point in time, and the actual principal increase on a 30-year loan term on a $10,000 or a $15,000 insurance premium, it's a hell of a lot less than any of the other insurances we pay, right? The actual servicing cost of that insurance. So to get into the market quicker, I've seen people, obviously we always try to minimize LMI. That's the critical point. We're always trying to minimize it and avoid it if we can. We have the discussion around security guarantors. Can you introduce additional cash from another source? Well, we have those discussions to try to minimize it or avoid it at all costs. But if people have no other option, then it's a cost you wear, and you try to minimise the cost. And the important thing about it's probably a little bit lesser known, like the valuation tools within the banks, is that lender's mortgage insurance is like any other insurance. There's competitors in the market. So the two primary competitors are Genworth and QBE. Genworth's by far the biggest. They're signed up with a lot of the banks. QBE's, they're still a very big player in the lender's mortgage insurance space. And interestingly, the insurers have different deals with different banks. And some of the banks write it themselves. So Macquarie writes their own lender's mortgage insurance. ANZ writes their own lender's mortgage insurance. So there's multiple players in the mortgage insurance space. So it's often a situation where I say to clients, look, we get a pre-approval in place. If you end up buying a property and you're still in LMI, we have to do a full review at the time of purchase, because because the two things which determine the actual LMI amount is the loan size. So the bigger the loan size, the higher the percentage of lender's mortgage insurance as a percentage of the loan, and the higher the LVR. And there's some very important thresholds for the LVR as well. When you go over 86, 88 or 90, the percentage jumps up considerably. So quite often we find, all right, if these two lenders, when compared side by side, the insurance premium is different by $2,000. So you can save, all of a sudden, the interest rate, you might have been saving $20 a month or whatever it is, but there's a $2,000 difference in LMI. So you're better off going with the lender that has the higher interest rate. That's a common scenario, at least in the short term. And also, if you put in an extra $3,000 in cash, if you can come up and get under that 88% base LVR threshold, you'll save $5,000 in LMI. It's an incredible outcome when you look at the actual dollar figure, how much your LMI comes down by.
So not having a 20% deposit is not a reason to not go talk to your broker. Is basically
no, definitely not.
Yeah.
Obviously, as I said, we always strategize over how to minimize it, how to avoid it, if it's at all possible. And then if it's a reality, we try to give you comfort around it to actually break it down to a nominal cost on a monthly basis. And of course, you always know that if you buy well through the likes of yourselves, and the property you've paid $10,000, $15,000 in LMI, the value of the property goes up $15,000. It's effectively paid off.
We have a lot of people that come to us and say, "Hey, I don't have any saved up deposit. I make 120, or combined with my partner, we make 300K.
Yep.
We've got only $10,000 in our bank account, but we've got $800,000 equity."
Yep.
Explain that.
Oh, well,
And their belief is they can't move forward because they don't have enough saving.
That's our preferred scenario.
Yeah.
For an investor, because if you own a property, whether it's your owner occupied property,
Yep.
You've done the right thing, which we're all taught to do, and knock down the owner occupied debt as quickly as possible. And then all of a sudden your incomes have gone up and you've got a dreaded tax problem.
Yeah.
The idea is to borrow not just the 80% for the next purchase. You want to borrow 100% of the purchase price, plus the stamp duty, plus the legals, plus the lands and titles office fees. You want to borrow the lot.
So what you're trying to say is actually take all the equity out to pay not only the purchase but all the expenses as well.
That's right, and don't use $1 of your $10,000 in savings, because that would be, or if you've got $100,000 in savings, sometimes people think I want to put down $100,000. Yeah. It's not tax effective to do so. So you want to when you're looking at, you've got a golden opportunity there to effectively manage your taxes through an investment purchase. So we would. Obviously, borrowing capacity permitting, we would maximise the debt level in that scenario.
Now, someone, again, who's young, they're 22, 23 years old, they've been working for about a year or so, they've got a little bit of savings. What would their minimum requirement be to pick up the phone and call someone like yourself or us, or like yourself, I should say, for the borrowing?
Oh, if you're in any sort of permanent role or even a casual role for greater than 12 months, so you've got an income that is on the books and you've got savings, or the access to a security guarantor type scenario, it's never too young to start. I think it's legally you've got to be over the age of 18 or something, don't you? It's never too young to start. As long as you've got income on the books. And you're keen to kick it off, the earlier the better, really.
So what other barriers do we come across? We've got the LMI barrier, savings barrier, equity barrier, where people are scared to, like you said, borrow to 100 and something.
I'm going to hit the doom and gloom here.
The OTP barrier.
Well, the people who come to us and say, what if? What if they're working, they purchase something for $1 million, they've paid 20% deposit, it's an investment or it's an owner-occupier. What if something happens? What if I lose my job and I don't have that, monthly, payment to put through? What happens?
Well, definitely. I mean, as soon as you start looking at an investment purchase, you need to get your insurances in order, whether it be income protection insurance, life and TPD. You need to have a look at those insurances to cover you in the event of a disastrous life occurrence, which does happen. We try to give clients comfort around their equity position as well. So, okay, what's a doomsday scenario? Going back to your scenario a minute ago, I've got a $1.5 million home. We've got $800,000 in equity. We really need to start. Our incomes have gone up. We really want to start investing. But what happens if, one of us gets cancer or we're in our late 40s, one of us has a heart attack or some sort of other major issue? At that point, we'd say, well, what would be the worst that could happen if you had to offload the asset? If you had a major life event, all of a sudden, you pretty quickly realise what becomes important and what is most important to you, and it's not the investment property that you've leveraged to 105%. So you're not going to lose the family home in that scenario. You'd sell the investment first, of course, and hopefully before that disastrous life event comes along, you've received some, achieved some equity growth, and you'd walk out without even making a loss. But in a worst case scenario, you're making a little bit of a loss. You're realising a bit of a loss, but
How open are lenders to things like pausing repayments temporarily or hardship? What sort of hardship, I suppose, buffers do lenders offer to people?
Well, look, they're very hesitant to sell people, to wind up people out of their family home. I know that. I haven't seen a lot of hardship. I must admit, we didn't even see a high percentage of hardship cases during COVID. It was mostly people that were trying to be opportunistic, right? And just take advantage of the banks for a period of time. And,
I think the banks stopped assessing hardship through COVID. It was just a click of a button, if I recall.
Effectively, you're on the phone you're in line for an hour, you're on the phone for 5 minutes and it was done. But post-COVID, we haven't seen a lot of it at all. And I would say as well with hardship, they said at the start of COVID, it was definitely put out in the press that it wouldn't impact further lending, but it did impact further lending. If the banks could see, because they moved to comprehensive credit reporting, if they could see that you'd taken hardship provisions in the preceding 18 months, I think it is on the comprehensive credit report, you need to have a very good explanation as to why you did it. And certain lenders took a very dim view of that. But as I said, I haven't seen a lot of it recently, but I do know that all the banks have teams in place to deal with hardship. So if you call up and it's very different if you just call up and say, I'd like to extend my interest only period or whatever, they'll say, go and do a full loan application, right? But if you call up and say, this massive life event has happened, the banks do their best to accommodate you. I know that for a fact.
Okay, so we've talked about cooling off periods and, getting things like your pre-approval in place. A lot of people that come to us will have already spoken to their broker, as we said before. So they'll come to us with a number that their broker has given them, or some sort of version of a pre-approval, and they think, well, I'm guaranteed that money.
Yep.
But that's not actually the case, is it? Can you explain the difference between a pre-approval and then an unconditional approval?
There's a lot of buzzwords in this space, and the banks don't necessarily help because they have different terminology for an approval. The most common one you'll hear is a pre-approval. Unfortunately, in recent times, the banks, we always call that a conditional approval. For in-house, we refer to a pre-approval as a conditional approval. When we refer to a conditional approval, it's conditional only on the property that's being purchased, the valuation, right? Suitable security for the bank. Sometimes there's an additional item you've got to tick off, whether you've got to wind down a credit card limit or something like that for borrowing capacity. The client's happy to do it. We get it conditioned on the approval because there's no point rushing out and winding down your credit card limits and spending all that time if you don't even end up buying for that amount, right? So we might get conditionally approved at your maximum. Now, for a conditional approval, when I use the term conditional approval, the bank has fully assessed that application. So not only have they done a credit check, they've done the internal credit scoring as well. An assessor has picked up the file. They've looked at all of our notes. They've looked at the supporting documents, which payslips, tax returns, whatever it might be, IDs, saving statements, rental statements. They've ticked off all of those items and they've provided a conditional approval letter, which is subject only to the valuation. Mm-hmm. Now, there's a couple of lenders and for commercial reasons who have started to move to a digitally assessed approval. And I can understand why they're doing this because the banks will give you the stats on it, but it's about 20% of conditional approvals proceed to full approval. So you can understand the bank's hesitation to waste all those resources in getting individual staff members to fully assess approvals when they've got a 20% chance of converting to full approval. So the banks are moving towards a digital assessment, which is where effectively they just do a credit check, Equifax report. They scan the application. They don't actually look at any source documents, so payslips or any of that sort of stuff. They look at the LVR, so as long as the LVR is sub 80% in those scenarios, and there's no refinance element, so as long as it's just a straight purchase, sub 80%, and the servicing ticks, there's a net monthly buffer for borrowing capacity, they'll actually issue you an instant result for an approval. Now, if there's any hairs on that application, or if your broker accidentally puts in a figure in the income section which is inaccurate, you run the risk of when you move to formal approval and the bank actually does a full assessment that you will be declined. Now, we very rarely see that. And I must say, I'm quite comfortable moving with digitally assessed approvals for the majority of my clients because we do an Equifax report before we even send the application in. Before we even just move forward to application stage, we want to have a discussion with the client before we waste their time and our time if there's any issues that we should be aware of. So we do the Equifax report. We check all of their documents. We run a thorough servicing calculation, and we're in a position to effectively say, all right, this application will be approved so we know we're not wasting our time in preparing all the application forms and submitting it and going back and forth. So we do that before we put it in, and there are actually brokerages out there. I've been shown the letters from clients that have come to me. There are brokerages that actually will issue an approval letter themselves, so on their letterhead. So it's not from the bank, it's actually from the brokerage saying that you are approved because they've done the same checks and balances that we've done. Now, we don't do that because there's obviously an element of risk associated. We'd prefer to put in an application to a bank, get a digital assessment, bank ticks it off. There are some issues you can have with that, and if we're obviously looking to avoid that scenario where when you move to formal approval, you get declined. So sometimes we'll say to a bank, look, we've just put in a digitally assessed approval, like a pre-approval, Some of the banks even call them conditional pre-approvals now. So they've added in a bit more.
There's another condition on the
That's
condition.
right, conditional pre-approval. It usually says at the bottom of a letter, this is in no way an offer for finance, right? So you get the gist from the letter. But if there's any hairs on the application or any uncertainty from my perspective, I'll actually reach out to my relationship manager within the bank and say, can you please get a set of eyeballs on this as a favour? I know you don't do fully assessed approvals, but I need this item ticked off because it's slightly outside of policy. Maybe it's a visa type requirement or some sort of other income that I want the bank to include, but I don't want to rely upon just a digital, because the digital assessment will just approve it. If I put in $25,000 of other income, they'll just tick it off and say approved. When a credit assessor gets through it, they might have a different approach. So we like to get that stuff signed off before a client moves forward.
It sounds like there's a lot for people to wade through when it comes to, it's not just a case of, going to your broker and going, this is what I earn, this is what I spend, give me some money. There's a lot more to it just in terms of, policy level, like you said before, getting around LMI in different ways, the time period between, applying for that loan and then settling on the property. I mean, we've covered so much today. It's very overwhelming, and I'm sure a lot of our listeners are thoroughly bombarded with information that's so useful to them, but also quite complex to navigate through. So for somebody starting out who is young, like Dragan said before, maybe someone in their 20s have never purchased anything before, but they know that property is the way to go. They just might need, their hand held by a good broker or a good buyer's agent. What advice would you give to those people to demystify? And we've given it our best shot today, but it's still so complex. We could do 10 of these podcasts. Yeah. So for people like that who are overwhelmed with all the information, what advice would you give them?
Well, look, the best advice I can give is try to understand yourself. You've got to try to understand it yourself. Because the clients of mine that have really performed really well over time, they have a very thorough understanding of what I'm communicating to them. And they ask questions, obviously ask lots of questions. If I got out of mortgage broking, the first thing I would do is align myself with a mortgage broker who I knew was going to communicate with me and that I could bounce ideas off with a good mortgage broker. So choosing that professional is obviously important. Definitely, there's stacks of good mortgage brokers out there. I would be very hesitant to deal with a bank directly because you're limiting yourself to that bank. And that's not the advice that I'd give every owner-occupier in the market, okay, but specifically for investors, I would be looking at so you get a wider variety of options from a broker and that advice.
So you want options, definitely.
Yeah, and you want that tailored advice around all of the things we've discussed today, LVRs, risk, the risk that you're taking on if there's extended settlements. You want to make sure that the approval that you're getting is rock solid. You want to have a chat to your broker before you put pen to paper to make sure that there's not going to be any headaches moving to formal approval. So you definitely want to align yourself with someone who's fairly experienced, and there's stacks of good mortgage brokers, and you probably don't want to limit yourself to one bank.
Crazy.
So it's about the education of becoming financially literate, not just becoming a blind disciple of somebody, but actually skilling up yourself and knowing what you're doing.
Absolutely.
It's all about educating yourself.
And same with, I'd give them the same advice on the property side of things.
Yeah.
Before you go and even engage the likes of yourselves or buy a property yourself, go to the library and hire 3 books on property and read them from experienced investors. Learn as much as you can so that when they're coming to see you, an expert in the field, they're just plugging the gaps and and they can actually work with you so that there's not that unknown, because a lot of the time I find the fear or the hesitation from people to make a move is from having just a knowledge gap.
Yeah, and asking the right questions.
That's right.
That's all it is, really.
Once you plug that knowledge gap, the fear is removed.
So, Anthony, where can the listeners find you if they want to continue this further with a discussion with you guys?
Well, the mortgage brokerage is called MortgageWorks, and we're info@mworks.com.au, so www.mworks.com.au. Obviously, you can follow us on Instagram, see what we're doing as the team and what promotional information we're putting out. But certainly feel free to reach out via the website at mworks.com.au and you'll be in touch with a good broker.
Amazing. And obviously I'll provide a link below this video as well. Okay, fantastic. And anyone out there, you can reach out to us as well. So, I'm happy to share the information with MortgageWorks. Thank you very much for today. Very informative.
Thanks for having me.
And I'm sure people out there are going to get a lot out of this.
Sounds good.
And we'll have you again.
Sounds good. Thank
Amanda,
you.
thank you.
Amanda.
Thank you. Thanks,
Thank you
Anthony.
very much.
Appreciate it.
Guys.
Thank you for all the listeners out there. And until the next podcast, see you then.
The Passive with Property podcast is brought to you by the Buyers Agency Australia.